Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And if you're thinking of pulling money from your 401k, like many Americans are right now, you want to watch this video to the end because withdrawing money or taking out a 401k loan can cost you a lot more than you'd bargained for. In fact, depending on which state you live in, you could incur taxes and penalties exceeding 50% for early withdrawals from your 401k plan. Now, this is on top of the long-term consequences of tapping into retirement savings. So in this video, we're not only going to cover exactly what you can expect to pay in penalties and taxes, but we're going to provide a few alternatives to pulling from your 401k at the very end. So, Brian, let's start with the new data that shows investors are pulling money out of their 401ks at record rates.
Yeah, they definitely are, Michelle. You know, a recent study from the Transamerica Center for Retirement Studies revealed that a record 37% of Americans have resorted to early withdrawals, loans, or hardship withdrawals from their retirement savings.
Jeez.
The study also suggests that most Americans are depleting their retirement savings due to financial emergencies, such as avoiding eviction or covering medical or disaster-related expenses.
Interesting. So, what's going on that's compelling people to tap into their retirement savings?
You know, one possible explanation is that many Americans have insufficient emergency funds and
Yeah.
rising debt levels. You know, the credit cards, the car loans, personal loans, housing, leading them to withdraw from any available resources they have, including their 401k plans.
Yeah.
And I hate to say it again, but we talk about it on the channel all the time. The situation's likely exacerbated by the ongoing high inflation and rising interest rates.
Yeah. It's not pretty out there, is it?
No, it's not.
Those rising interest rates are hurting a lot of people. I know that.
Right.
All right. So, let's talk about the consequences of early withdrawals, and then we'll talk about the 401k loans.
Okay. The immediate consequences of early 401k withdrawals include ordinary income taxes on the money that you withdraw if you're under age 59 and a half, and a 10% early withdrawal penalty, except for Roth 401k accounts and if you qualify for the 55 and separated from service rule. If you don't qualify for these exemptions, this means you may have to give up more than half the amount you take out to taxes and penalties alone. That's a lot.
It is.
So, let's say you take out a $10,000 out of your traditional 401k and you're under age 59 and a half. You may think you're getting $10,000, but what you're really getting is roughly $5,000.
Yeah.
That's half of what you're expecting to get. The long-term repercussions can be even more detrimental. Withdrawing money stops compounding interest on the money that you've taken out.
Yeah.
For instance, a $10,000 withdrawal may seem measly now, but if it left to grow at an 8% annual interest rate, it could amount to nearly $50,000 in the next 20 years.
A lot of money wasted. All right. So 401k loans are different and they don't seem as detrimental to retirement savings as early withdrawals do, but there can be a hefty price with these, meaning taxes and penalties if things don't go according to plan. So let's dive into 401k loans.
Yeah, that's correct, Michelle. 401k loans don't seem as bad because they do not incur the IRS penalties and the interest paid goes back into one's account, right? Yeah. But borrowers will miss out on potential investment returns while the money is out of the account. But if they can pay it back on time, there's going to be no penalties and taxes owed. However, if you fail to repay that loan, the entire amount becomes a taxable distribution. And this means it will have the same penalties and tax consequences as a withdrawal. I've seen too many people take out 401k loan, Michelle, with all the intention of just paying it back, right? Then they get laid off or some major emergency hits the family. I've also seen it happen because a company files bankruptcy and shuts down.
Wow.
So of no fault of your own, your 401k gets frozen, you have no job, and your 401k loan is now considered a distribution.
So real quick, that actually happens if your company files bankruptcy, shuts down, they freeze your 401k.
401k gets frozen until the bankruptcy judge allows it to be accessed.
Got it. Okay. And instantly that 401k loan becomes a distribution.
Automatically, because with the company filing bankruptcy and it goes through the bankruptcy process, that 401k loan will terminate. So,
got it. Okay.
Because the plan terminates. So the company's no longer there. So, also, if you don't have emergency savings set aside to ensure you can cover the loan payment each month or cover it if you default, I'd advise not even taking out a loan at all.
Okay. All right. So, what do you suggest for someone who's watching, who's thinking about pulling money out for early from their 401k, whether it's a withdrawal or a loan?
Well, let's start off with if you need the money right now and you have no other choice, you have to do it.
Yeah.
Okay. It's that simple.
The
But
key is if you have to do it, just know what
you
the
have to do it.
implications are. Yeah.
Exactly. But if you don't need the money right now and you can wait, here's a few alternatives that require a little bit of planning. Okay.
Okay.
First of all, and we talk about this all the time on this channel, open and contribute to an emergency fund until you reach a set goal.
Yeah.
By doing this, you'll help your budget for emergencies such as like a car and home repairs or medical bills.
The other thing about this, from personal experience, I've done that. I've set my goal, reached my goal, and then guess what I start doing? Tapping into it without putting it back in.
Right.
I don't
Right.
do that anymore, but it was for years. So that's another thing. Don't touch it unless
Don't touch
you
it.
absolutely need it for an emergency. And if you do need it, put the money back in.
Focus on that new goal of refunding back into that account.
Sure.
So.
Okay. What's your second?
Next, open and contribute to a Roth IRA account. Why? This allows you to withdraw your contributions tax-free in a real emergency. It's like having a secondary emergency savings account.
And a lot of people use it as such, right?
Yeah, exactly.
Yeah.
Exactly.
Okay.
And if you still need additional funds, consider using a 0% credit card for short-term expenses, but make sure you can repay the money before the promotional period ends.
All right. So here's the thing. If you're leaning toward pulling out money out of your 401k right now, I want you to go check out this video we did on cashing out your 401k and how you may be able to avoid the 30% penalty. So it covers some of the things we mentioned in this video, but it goes way more in depth. So check that out. It's going to be in the description and the pinned comment below.
Definitely.
Also, if you like this video, hit that like button, leave us a comment below, and don't forget to subscribe. So Brian, before we wrap this up, any parting words of wisdom?
If you have to do it, like I said before, do it. If you don't and can hold off a little bit, start planning for emergencies and put that emergency fund back. So,
okay. Again, like this video, hit that like button. Don't forget to subscribe, leave us a comment, and thank you so much, Brian, for this. And thanks to everyone who watched.
thanks, everyone. Have a great day.